Hi, everyone. This is Carey Archer-Howell with Lux Living LV with Carey, where we talk about real estate, wealth building, and everything you need to know confidently about moving into your next chapter. Today, I am excited to welcome Mr. Kevin Musico. He's an agency owner with Goosehead Insurance. Kevin helps homeowners protect one of the biggest investments of their home, which is home insurance, which is what we're going to be talking about today because it's not a very common topic to talk about when it comes to real estate. Today, we're going to discuss about how real estate and insurance works hand in hand to help families build wealth and protect their future. So, Kevin, welcome to my show.
Thank you for having me. I'm glad to be here.
All right. Kevin and I met at Keller Williams. And the day that we met, there was actually an earthquake that had happened. So in the Philippines, and then there was an earthquake that happened here in Las Vegas, which is kind of an odd thing. Most people don't think that there are earthquakes here. So I met Kevin and said, you know what, I think this would be a great idea to let everybody know about home insurance. It's not really something when folks are buying homes that they're like, oh, let me think about home insurance and what's the best coverage and what'd be best for me. And everybody's just pretty much overwhelmed. And so Kevin is our expert. We're going to get a little more detail on when folks decide to sell or purchase their home, what they should do with insurance for their homes. So, let's just introduce you, Kevin. Why don't you tell us a little bit about yourself and your journey into insurance?
Sure. So I took a non-traditional path to get here. I started out my career in healthcare. I used to be the assistant administrator and run a hospital up in Northern California, or not Northern Nevada, up in Carson City. And from there, I ended up transitioning into consulting. And I did a very specialized kind of consulting. It was turnaround and bankruptcy consulting. So I went in and helped high-risk companies turn around if they were operating and started failing and banks started saying, we're calling your loan. They would call me and our team in, and we'd go in and we'd assess and fix them and adjust their risk profile and all kinds of things around making them solvent and whole. And I did that for a number of years. It exposed me to just about every industry out there. I've been in and out of hundreds of companies. And it evolved into me getting recruited into several executive roles with large international companies, multinational public companies. And, one of my roles there was doing mergers and acquisitions and managing real estate portfolios, but very large ones, where we had thousands and thousands of locations in several countries, locations in every state in the U.S. And through that, I did that for a long time and transitioned into several other things. I have a lot of friends that knew my background that asked me to help with their companies. I was the chief operating officer for a energy consulting company. There, I ended up doing a tech startup. We saw an opportunity to help companies with a certain segment of communications and networking. And that launched a company that I did from ground up. And today is, it's on the Fortune 5000 list. It's one of the leading national network integration companies in the US. I sold my interest in that. And decided I wanted to get into something that I could, instead of dealing with kind of multinational large, how do I get closer to the consumer? And I was looking for a business that I could put my efforts in and over time I could build. And what kept popping up is insurance, retail insurance. I did in risk management at a large, company size approach, but kept popping up, and I decided, let me look into that. And I did. And ended up, long story short, my wife and I decided to go into business together. And we jumped in, and we were going to open up a State Farm agency. And we traveled the country to find where we wanted to establish. At the time, I was living in Tennessee. Okay. I had started out here in Nevada. I got married in Gardnerville, 33 years ago. And my career took us all over North America. So we traveled quite a bit. Anyway, we came back, and we were going to open up an agency in somewhere in northern Nevada. And we got back here, signed up with State Farm. We passed all of the pre-requirements to be agency ready, and we're in, and COVID hit, and we were working, and State Farm decided to change their focus. They were worried about too many agency owners retiring, and they changed their compensation model. And the retirement that we were taking over decided not to retire, and none of the agencies that were open in northern Nevada they all decided to stay in business and not retire. Mm-hmm. And the State Farm said, well, we're not allowing another agency to open. And we went, oh boy. Well, no. Let's go find something, and decided to open up our own independent brokerage, which is Goosehead Insurance. And we opened up, we're in our 5th year in northern Nevada, started in insurance in Tennessee. And, we haven't looked back. This has been an unbelievable opportunity. We have more than 80 carriers that we have available, which is more than any brokerage you'll talk to. And we specialize in homes. Our primary focus is personal lines, homes. Now, we do everything, but we're kind of unique in that we love to step in and help folks like you with your clients really make the right decisions and get the best coverage. And we have a lot of options. Okay.
So you do a little bit of bundling, I guess.
Yeah, we do.
That's what the consumer would think of it as, is bundling, right? Because that's the coin word is bundling, but it's all about, mostly your products are home products, correct?
Yeah, homes, autos, RVs, investment properties, seasonal properties, vacation places, short-term rentals, life insurance, anything, even business insurance. But our core is really about the family. Our whole premise and our real motivation is to get in and really protect a family. And that usually starts with a home and cars, and then it might be an investment property, and then it might be a recreational vehicle or an ATV or something like that. But we're positioned to cover all of those things, including, what, the consumer thinks of as bundling their home and auto, but we'll go much further beyond.
Okay. Was one, so just question about that. As far as the bundle, do you suggest that all assets that people have, do you suggest that everybody puts everything under one umbrella, or
great question,
or is it better to have things separate? Is it maybe talk about that a little bit.
Yeah, that's a great question, because the concept of bundling came from, the large captives that were trying to capture more business, and their marketing departments said, hey, let's come up with a cool catchphrase. Yeah. And they did. And they encourage you to bundle. So the best way to go about it, so maybe it's better to step back. There are 2 general types of insurance professional you can go to. There's what's called a captive agency, And those are places like State Farm or Country Financial. They're one insurance company that has a bunch of offices around, and those agents work for that company. So when you talk to a State Farm agent, for example, they work for State Farm. It's not really their business. They may have their name on there, but it's a State Farm. And when you go to buy insurance, the only products they can sell are State Farm.
Okay.
When you go to an independent broker, we don't work for an insurance company. We represent the client, and we have access through appointments to a bunch of carriers. And that's how I have 80. So if you come to me, oh, I'll shop you with Progressive, and I can go to a whole bunch of carriers that I go look at your circumstance and say, let's find the best. So kind of a long way to get to answering your question. But what's most important is not necessarily bundling it all with one carrier. That might be the best option. But what you want to look at is, well, my current situation, this particular home fits best with this carrier, and my cars and kind of some other things I have, well, I can get a better rate with this carrier. And that's where a broker is able to help you in that regard. A captive can't. They can only sell you State Farm. I like giving people a visual analogy. Imagine if you're walking down the grocery store aisle for breakfast cereal. You go down and there are a whole bunch of choices there. If you're going to a captive, you can go buy Cheerios. And there's a few varieties of Cheerios. You can get whole grain, you can get frosted Cheerios, but pretty much that's all you can buy are Cheerios. But what happens if your need is that you want oatmeal, or you want Rice Krispies, or you want Frosted Flakes? That's where a broker comes in. So captive gives you one brand. Broker gives you the ability to shop a whole bunch of options. And in that regard, if somebody's shopping, it's best to look at all the options and then find the best fit. Sometimes you may be surprised that, wow, if I break it all up, not only am I getting a really fair value, I'm getting really the right insurance for my need.
So question about that, as far as using a particular insurance company and then using a broker, I would say the consumer, because I don't know much about insurance either. So as thinking of it on both ends now, would it be, because the consumer is always thinking about cheaper, right?
Right.
Not necessarily the best coverage, which is kind of crazy, but they're mostly thinking about cheaper. So as far as using a national broker like State Farm, or using a smaller company broker as yourself, is there any savings that happens there between the large conglomerate compared to the small company?
Yeah. So I'm so glad you asked this question, because we get calls probably every day. Somebody thinks that when they call an agent like us, that we actually control pricing. Okay. So the way that the industry works, all of the carriers look up at a profile, and they have these rating tables, and it's regulated by the state. It's not like they can charge anybody anything they want. And that's what sets the rate. So if you come to me or somebody else, I'm not giving you different pricing. Everybody is pricing things the way that they think the market fits. So let's take Clark County, for example. In Clark County, if a particular carrier is saying, I want to be more competitive, I want to get more market share, let's say it's Mercury Insurance, they'll go in and their underwriters will write risk, which is, you, and they'll look up at your profile and say, you know what, I'm willing to take on that risk, and I'm willing to price it generally here. They have rating tables based on past experience, and we'll talk about that in a little bit, but they set that price. And if they're interested in capturing more market share, they'll tend to be accept higher risk things or things that other companies aren't willing to, and they'll price it competitively. Not like you go buy a hamburger and they can say, I'll sell it to you for $1, but they'll look up and say, you know what, I'm willing to use this rating table for this person, whereas the other company might use a different rating table and the math works out to being a little bit more expensive. So it doesn't really matter that you go to a big company. One of the benefits of our industry is that it's regulated quite a bit. And the state Department of Insurance regulates all the carriers. And it says, these are kind of the rating tables. This is the way your policy will look. We're going to authorize this kind of price increase this year to offset building costs and everything else. They can't randomly go out and say, I want to charge $1,000 more today. They have to go to the state for approval. The state makes sure, and this is the important thing, that carrier is solvent. So whether it's a big giant State Farm or, that's one of the largest in the country, or it's a Mercury that's regionally a very competitive carrier, both of them are financially solvent. Both of them are not at risk of going under. So you're not really getting something. It's more of a peace of mind and good marketing. That's why when you watch TV, you'll see, watch the sporting event and see how much State Farm promotes and sponsors teams and stuff. Why? Yeah. Because they're getting their name out, because they know at the end of the day, we're all the same. We just want people to think of us more.
Right.
So it's not necessarily the size of the company. You really just want to find the best options. And pretty much we deal with A-rated or better carriers. That's the metric. It's not something that's always visible to the consumer. But, when you see online, maybe you've been online or, on a social media feed and you see, wow, I can go get full coverage auto insurance for just $12 a month. Okay, that's bogus for a few reasons. One, it may be like a B or C rated carrier. And two, the term full coverage is another marketing term. There is no such thing as full coverage. There's legally minimum required coverage. So for example, in Nevada, you in car insurance, that's what most people know. And they go, oh, I got full coverage. Right. Well, you might get what's called 25, 50, 20. Those numbers mean something. It's $25,000 per person, $50,000 coverage per accident. That's the legal minimum requirement. So when you go to the DMV and they say produce insurance, you have to produce insurance that has at least that coverage.
Gotcha.
You can opt to get 100, 300 coverage, which is $100,000 coverage per person, $300,000 per accident. People feel good about, I got insurance. I got the 25, 50, 20 coverage. Hey, I'm good. I've got solid coverage. I want you to think for a moment that if you had a bad accident, let's say it was you and 3 other people in the car, right? And you only have $50,000 to cover all those people, and there were some serious injuries.
Yeah.
Well, that $50,000 is gone pretty quick. Your insurance will write the check up to $50,000, and then you're on the hook for the rest.
Oh man, yeah.
So people don't realize. Let's say you're out on one of the rural roads, and they have to call Care Flight in to come pick you up and bring you to the hospital. Right. That Care Flight could be anywhere from $20,000 to $80,000.
Right.
Okay. Well, you've already exhausted your individual, your per person. It's capped at $25,000, and you've already exceeded your accident. The rest of that comes out of your pocket. Now, here's the crazy part. If you just up that coverage just to the next level, go from 25, 50, you go to 100, 300. The price difference is very small.
Really?
It's not super significant.
Okay.
Yet the coverage that you have is really much better. So that's what we look at. That's another reason you go and you want to find, a really good professional agent that can represent you, to look out for your interests. That small change makes all the difference in the world. We don't write state minimum coverage because we know it's not really the right thing for any client.
Gotcha.
And at the end of the day, if somebody's super price sensitive, there are carriers you can go out, you can meet the minimum requirement and you can be legal with a state.
Yeah.
It's not something we do because we want to protect you. We want to make sure that if something happens, it's covered. And if your auto's, destroyed, that you have coverage to replace it.
Yeah.
That if somebody's hurt, you get that paid for. That's the kind of stuff that most people don't really think of. And it works that way on home insurance too. I'm sure we'll dig into a little bit more on home insurance.
Yeah. So since you touched on that right now, my next question is, what's one insurance surprise that many buyers of real estate don't expect?
So let's talk about the typical home transaction. That's where you and I are going to come into contact with consumers that need it.
Right.
So probably the biggest surprise that most people, and you probably are familiar with this, but insurance has become a very important part of that whole transaction.
Right.
Couple reasons. One, if you have a mortgage, you have to have insurance. It's not optional. Unless you have insurance, you cannot close that transaction. So all of a sudden, that insurance professional and that insurance transaction has been elevated in the scheme of closing that deal. The realities that have happened in our industry are that certain things about a home have become game changers. They have become the eligible versus ineligible to insure that home. And we see it often that people find that perfect home and then they get in and they realize, what do you mean I can't get insurance? So the big surprise is, the roof. A roof on a home is like the tires on your car.
Okay.
If they're not maintained and they're not in good condition and they're not newer, 20 years is the magic number. Insurance companies say that roof is at risk of failure, so we're not going to insure that home unless you replace it. And that we are seeing that has evolved to most people looking up and going, wait a minute. What do you mean I can't get insurance right now that the roof doesn't qualify? It looks good. Well, there's some science behind why that roof and its age is scrutinized so much. There's an organization for the industry and for consumers. It's called IBHS. They're really kind of a cool organization. They recreate hurricanes, wildfires in lab environments, in large warehouses. They'll build a house and they'll go recreate what happens if an environmental something happens. High winds, a hurricane, rain, hail, and they apply it to that house and they see what happens. Well, what we've learned over time with a roof is that when a roof reaches a composite shingle, think about architectural or composite shingle roofs. That's the one that's most in question. Fortunately, a good many homes in Clark County, they're tile. So they don't fall under the same scrutiny, but a similar scrutiny. Anyway, they discovered that after about 18 years, that roof system starts to fail. Doesn't matter how good, because they're all exposed to conditions, rain, heat, sun. And after about 18 years, they start to fail. That's why the insurance industry is adopted this 20-year demarcation.
Wow.
Because at 20 years, we know statistically it may fail. Now, that roof may not fail this year. It may be in better condition and not have but we know that 20 years is the magic number. So that's something that they look up, and we often are like, well, why are you asking that? Why do you want to see when the roof was replaced? Well, because most carriers, they'll come and inspect. And if they believe that it's older, you have no proof of that, they will require you to change it or they'll cancel your insurance.
Oh, wow.
And that's a big surprise because it's a big ticket item. You know, it can be $20,000 for a new roof.
Right. I'm unfortunately, I've never come across that, but that's great news for me to know.
Yeah, and it's newer. We haven't seen it quite as much in Clark County. We see it in other areas. Most people don't know that 80% of all roofs across America are composite shingle.
Oh.
And here's another crazy fact. Of all of those roofs, more than 80% have less than a 4-year useful life left in them.
Oh,
so
God.
that's why the insurance industry is saying, you know what, 80% of the roofs are almost at their end of life. We got to do something. Otherwise, we're replacing roofs and we're going to get stuck with a bill. We have to have consumers take responsibility, get a new roof, and then we start the clock over and you'll be fine for the next 20 or 30 years.
So what's another, besides the roof, what are the major things about the homes that the insurance companies will not insure that we have to look out for?
So it really is simple. I teach a class to realtors on this because I figure the more information you have, the better you represent your clients. And this forum's great for helping your consumers understand. So think of it this way. It's the major systems that the insurance carriers care about. Okay. So if you think about the roof, the plumbing, the electric, and the HVAC.
Okay.
Those major systems, plumbing, if it's worn out or it has older plumbing that may have a type of pipe that's been proven to fail, the insurance companies now know that and they want to know, well, are we going to end up with a water claim?
Right.
The roof, obviously, we just talked about. Electric. Over time, we learned that certain breakers, like in panel boxes, over time, they learned that manufacturer had faulty equipment. So they want to know, like, if that's older, we need somebody to inspect and make sure that it's not a federated breaker switch because we know those fail. If it is, change it and we're good. But if not, you got to look at it. So those are a few of the things to look at. Here's the biggest one that they look at that most people, it's a big surprise. In insurance for a home, most people think, and this goes across the board, it's professionals like you as well as consumers. They think, let me just call up somebody. I'm going to give them an address and give me a quote. Well, the insurance industry uses two things to determine what's called a bindable quote. Okay. That means a quote that they're willing to stand behind and insure you on. Okay. They can give you a price without all the information, but they need the other stuff. Here's the big one. So they want to know the address. So the physical address, you list a home and you're representing a buyer, you go find the perfect home. That address is the first piece of information that we need and the insurance carrier needs. So that we look up that address and go, great, we have that address. Okay. And what the insurance companies do is they run what's called a clue report. That clue report is something that's maintained by LexisNexis. It's national. It's on every claim that's out there. And it's very generic information that's collected by address. So they know, gee, that house has never had a claim ever. That's great in our book. And they check it off and say, that's a good risk. On the other hand, they could look up and go, wow, in the last 5 years, that house has had 3 water claims. Something's wrong there. So that's how they use that information. The second piece that most people don't understand, and this is why they get frustrated when they call us and say, here's an address, just give me a price. The second piece that all insurance policies look at is the insured. So let's use me, for example. Okay. I go to buy a house, 123 Main Street. They're going to look at 123 Main Street and say, what's the profile of that house? It's clean. Then they're going to look at Kevin Musico, and they're going to go look at the same type of clue report on me. Okay. Now, it doesn't matter where I live. If I live somewhere else, but I have a propensity to file a lot of claims. In the insurance eye, they say, I need to understand better. Why is this person either ending up in situations they got to file a lot of claims, or they feel they need to file a lot of claims? So they'll look at them.
Yeah.
And if they look up and say, this guy files claims for every $300 thing that happens, that's not somebody behavior in somebody we want to insure. They may not insure you. The house could be perfect, but you and your behavior could be somebody that they say, I just don't think I want to insure somebody like you, because your profile shows that you aren't as responsible as this guy over here that didn't file any claims for that same house. He's a better risk for us. So those two things are things that most people don't realize they look at. And sometimes when you can call up pretty much anywhere, and they can put in bogus information and say, yeah, that house will be about $1,200 to insure for the year. It's not bindable. That's the magic word you want to know. You want to make sure, is this a bindable quote? And the only way to get a bindable quote is to run the full profile of the insured and the address. And when I say run, it's not a big deal. We get some basic information from a consumer. Like if your client needs insurance and you say, hey, I'm helping my client, the best thing to do, we call them. We say, hey, I just need your birth date. I need some basic information. What was your prior address? That's enough for us to go out and look. And then they come back. And if we get a bindable quote, they can feel pretty confident, as long as nobody lied in that process, that I have insurance and I know what the price is. It's not going to change. When you go to others and they say, yeah, it's about $1,200, you go to close on the deal and they go get the bindable quote. And all of a sudden that $1,200 turns to $2,800. Now you're surprised, your loan officer's surprised, the consumer's surprised. So you want to make sure that you really look at that. And, bindable is the magic word.
Okay. Well, so question about that, being on the consumer end, when would be the best time? So you're not one of those insured where the insurance companies are going to look at you and say, oh, I don't think I'm going to be able to insure this person. So, obviously if you're going to have insurance, and when is the correct time to file a claim?
So we're going to talk about two things. One, when's the best time to start looking and engage? And we're going to assume we're talking about somebody buying a home. This applies anytime. If somebody's just reshopping, we can also look at that. But let's assume you've got a client, they're buying a home. The best time to engage in that is the moment they identify that they're going to make an offer on that property. And I think you're aware that in Nevada this past year, they changed the real estate contract with a section now of insurances as being a condition of sale. Yeah. And that you want to make sure you have that contingency built in, because what's happening is people are getting in the process and discovering, oh, I can't get insurance, and now they don't have an out and they lose their earnest money. Oh. This is just a mechanism for them to protect that. So early is better. And then as far as claims go, there's a rule of thumb. Matter of fact, I did a social media post on it because we had so many people asking. I did something that talked about it. There's no hard and fast rule. However, what you want to do before you file a claim, you want to look up at your insurance policy and look up at what your deductible is.
Okay.
And you want to go weigh that deductible against the damage. So I'm going to take an example that's right on the fringe, because this happens quite often. Maybe had high winds, a tree branch fell and hit and broke a window. And now you look up and go, I got damage from a storm and it hit my house. And let's just say, for sake of discussion, it's $1,000 deductible. And it's going to cost you $1,900 to get that window replaced.
Okay.
What you want to do, regardless, if you file that claim, you have to pay the first $1,000. So $1,900 now becomes $900. And now you file a claim and the insurance company says, great, we'll get that fixed. Here's a check for $900.
Okay.
The insurance company and your insurance profile for that home and for you personally now has a claim on record in that clue database I talked about earlier.
Right.
So now you want to look up and go, for an extra $900, was it worth it that now for the next 3 to 5 years, I have a claim on my record that's going to cause an insurance carrier to put me in a higher risk pool, and means that probably at renewal, my insurance is going to go up.
Gotcha.
So usually we look up and say, I mean, it's something that's really a case by case, but let's say that same scenario, you had $1,000 deductible, but was $6,000 of damage.
Okay.
You might look up and say, you know, that's worth it for me to file a claim because I don't have an extra $5,000. And the difference that they may raise my insurance next year, you might get $100 increase next year. It won't offset over that time. You look up and go, I'm willing to absorb that because I didn't have to pay $5,000. So it's really important. We have some people that don't understand that, and they'll go file 7 claims in a year for all of things that are a few $100s, and the insurance company will pay it. But guess what? When it comes around for renewal, they may say, I'm sorry, I'm not renewing you. Well, why? Because you filed 7 claims. That's just not something we are in business for.
Right.
We want to protect you against the big things, not the little things.
Okay.
And now that person is uninsurable. Now all the insurance companies look up and say, well, boy, they filed a bunch of small claims. I don't want them. Now it becomes very difficult to find insurance.
Oh, wow. Well, that's news. And that's, wow.
Yeah.
That's not a good thing. Yeah, that's good to know. So I guess it kind of reminds me when you were saying, talking about the story, it's kind of like the boy that cried wolf a little bit.
Yes. Yes.
Right? The boy that cried wolf always.
Yep. But when he eventually needs the help didn't come because it was all the little things that, look what I did.
Well, so another question about the Nevada market and the insurance trends are rising insurance costs affecting buyers? Do you see them kind of pulling back, or how is that affecting the insurance industry?
So high level. So we are in what's called a challenging market. When we look across I'm licensed in multiple states, so I can speak kind of, very intelligently about this because we have lots of different states that we operate in. In Nevada, we're what's called, it's a more difficult insurance environment. We have a few things against us. In northern Nevada, we have wildfire. We're very close. Reno and Lake Tahoe, very beautiful places. It's the second most populated area of our state. They are very susceptible to high wildfire claims.
Okay.
So because of that, insurance companies want to stay away from it, so they make it more difficult to find insurance, and it tends to be more expensive because that risk of fire, they have to adjust their pricing in the event there's a fire that they're able to cover it. Okay. So we have that going in the north. In the south, we don't have the same wildfire risk. We have it in Mount Charleston. There are pockets. It's some people think, well, wildfire really has to do with the trees and the forests. Not necessarily. It's actually the ground fuels that are what all the insurance companies are looking for. Yeah. And if you think about a lightning strike that hits out in the rural area and catches some sagebrush and it's real windy and hot and dry, that starts rolling really fast. And that's what they're worried about. Now, we don't have the same, what's called a canopy fire, that really becomes uncontrolled in a wildfire. But so they look at our state and people say, well, I don't get it. We don't really have a wildfire risk. Well, yes, we do, because all it takes is a spark from a power line, or it takes a lightning strike, or a careless individual that did was out in the weeds shooting guns and a spark catches something. It's pretty simple to start. So those things impact us in Nevada. And then the other is that we've got a few things that work against us. Unfortunately, when we drive down the highway and you look up at all the billboards, what do you see? You see accident attorneys. You see a lot of, we'll go after the insurance company. We'll get you millions of dollars.
Yes.
In the state of Nevada, and this is why the insurance industry as a whole treats us differently, we have what are called uncapped awards. So when somebody goes in and says, I tripped and fell, I'm going to sue, it's not a reasonable award that's paid out. If you get a good attorney, you could end up with a lot of money. I'm going to give you an example of something that happened a year ago.
Okay.
So I'm not sure where this happened. I don't think it was in Nevada, but it gives you an example of what could happen. Somebody was going through a Starbucks drive-through. They ordered a hot tea. It was put in a drink carrier and handed through the window, and it wasn't pushed all the way down in the drink carrier. And when it went through the window, that hot tea spilled in the driver's lap. He got burned. He got a really great attorney. They awarded him $50 million.
Oh, wow.
For one hot tea spill in a drive-through.
Wow.
The insurance companies, they pay out a certain amount, but they're the ones that have to defend against that. And when we have such a favorable legal environment to the attorneys and those uncapped claims, the insurance industry says, I either don't want to play there, I don't have to, or if I do, I'm going to be really critical about who I insure, and I'm going to have to charge more, because that state is there's just more claims and the payouts are much higher. So that's huge. Is
Nevada, are we one of the only states that has that uncapped claim?
No, we're not. But there's some other states that have put regulations and things in place that help curb that. And it makes it a little bit easier for the insurance companies to play. At present, we aren't one of those. The last big one that we have here in Nevada that really impacts us, and I'll kind of give you the stat overall in the industry, but we have a lot of fraudulent claims. And it could be something as simple as, well, it was windy and I did have a cracked window, and I think I'll file a claim and say it was, it was storm related. Those are, they're fraud technically. They're innocent. They're somebody that's just trying to game the system. Yeah. But more so we have, and Clark County really is the driver for this. Take the auto side of the equation. Okay. We have a lot of people that'll pull in front of you, hit the brakes, get rear-ended, get out and go, oh, my neck, file claims.
Yeah.
And it was a bogus accident. Unless you have a dash cam in the car behind to show that that's what happened, the insurance companies pay out because it's a rear end.
Right.
Most of the time, the person behind is at fault. And they look up and go, it's out of control. The amount of fraudulent claims is really high. Right. Now, here's a stat nationally. It's not just us, but the amount of fraudulent claims that the insurance industry absorbs every year is to the tune of like $300 billion.
Wow.
It works out between $900 and $1,200 per insured person every year that's bogus that they're just having to cover. And those kinds of stats, make it difficult. So when people look up and go, but I don't understand why it's so expensive for me to get insurance. Well, when you start adding all of that up, insurance is a business.
Right.
They're in business to take advantage. They're regulated on that. People think they're taking advantage. They're not. They're just trying to survive because they know that if I insure you, you know what? There's a statistical chance that I'm going to get some fraudulent stuff and I'm going to have to pay it. So I got to price it differently. And that's the challenge we have.
Well, and it's good that to hear it on your end, because that is what most consumers say is like, why is it so expensive? Insurance is always going up, and why is this is ridiculous? But they're not thinking about the other end. So it's nice to hear on your end just what is really happening. So if you flip that coin, maybe paying that higher insurance rate makes sense. It maybe is not fair for certain people, but but we're dealing with human nature and humans who maybe are not so do make the best decisions. But unfortunately we all kind of have to pay for it, right?
Well, let's talk about the flip side. There are things you can do to make yourself more favorable. We talked about all of the bad stuff, the half empty glass. Well, what about the half full side of the glass?
Okay.
So here's what how the insurance industry looks at consumers. They're looking up and they're saying, hey, you know what? I cry uncle. I can't keep absorbing for you not taking personal responsibility. Historically, people long ago, they looked at insurance the way it was intended. It's for catastrophic coverage. Okay. I lost my house. I can't get a new one. I'll file a claim and get my house rebuilt. And that's what it was intended for. Over time, an insurance industry did it to them. They made it, oh, wow, just file a claim for your glass windshield. We'll replace it for free. Well, they've evolved the consumer to start treating insurance like a maintenance contract. So people are filing more frivolous claims to get somebody else to pay the bill because they didn't want to pay the $1,000 to maintain something. I like using the analogy with a roof and car tires. Your auto insurance doesn't buy you new car tires because they wore out. You look up and go, they wore out. It's getting dangerous. It could blow out. It could cause a bigger accident. I need to buy new tires. It's expensive, but I'll do it. Right. On a home, the roof is the same thing. They look up and say, I get you bought a house and it lasts a long time, but you got to maintain it. Like over time, it wears out. You have to buy a new one eventually. You can't keep looking to the insurance company to do that. So here's what consumers can do. Just start looking up and going, are there things that I can do to my home that could help my position? Well, don't file a bunch of small frivolous claims. Use it when you need to.
Yeah.
That's a big one that follows you forever. Do things like we talked about wildfire. There's some things that you can do around your house that the insurance companies go, wow, that person is really taking some responsibility to protect their house. So there's something called zone 0 or zone 1. It depends on who you talk to. That's the 0 to 5 foot radius around your home.
Okay.
All insurance companies look at that. It's been proven that if you maintain that 5 foot barrier by removing fuels, like don't let the weeds overgrow up against the house, don't have a tree growing up or a shrub against your house. Mm-hmm. If you just maintain that 5 feet, you have an 80% less chance of having a wildfire incident because a fire blew an ember in and caught something on fire. Your house won't burn. It's protected. So doing little things like that, the insurance companies look up, they go, you may not be at a super high risk of wildfire, but people don't think in terms of what happens if your next door neighbor's house catches on fire.
Right.
And an ember from that blows from there into your property.
Right.
If you take these steps, most likely your house won't burn. We like that. So we're going to award you by saying you've done those things. We're going to insure you. We're going to give you discounts for doing things that are taking care of your place.
Gotcha.
When you maintain and do those things, they view those as favorable. And they say, that's a better risk. We like that person more than we like this person. We like that house more than we like this house. And those are things that people can do. Now people go, wow, that's real expensive. No, it's not. It really isn't. Taking the time to do that 5-foot barrier, that's either you going out there and trimming and pulling some weeds, or maybe spending a little bit of money on that. And all of a sudden your risk profile goes way down.
So do the consumers actually call into the company? Maybe tell them like, oh, hey, I bought a fire extinguisher, one for upstairs, one for downstairs, one for out in the garage. Does the consumer actually call in to their insurance company to let them know?
So the way it works is usually what happens, like when you get, best time to do it is at renewal or if you're shopping. So let's take a new home. That's the easiest kind of ground zero to show what happens. Mm-hmm. Two homes have two identical homes that one's taking care of it and the other hasn't. So when you go in and we're doing what's called pre-underwriting, we're asking a bunch of questions. We look at your listing photos. If you're the listing agent, we go look at the property. We use Google Earth. We use a whole bunch of resources to go look at that home. We're going in and identifying, hey, that 0 to 5 foot radius, they've done a really good job. We're checking off that they've taken hardening steps to make that, more fireproof. And those kinds of things get added up as the underwriters look at that application. Yeah. They see, oh, they've done that. Oh, look, it's a new roof. It's only 8 years old. That's really good in our mind. That means it's in great condition. Hey, look, we noticed that they did these things. Oh, they have an alarm system that's monitored to a central monitoring. That we know if somebody breaks in or a fire breaks out or a smoke detector goes off, we know the fire department's going to be called. We don't have to rely on that consumer. We're going to give you a discount for that because you're helping protect that home.
Right.
So there are little things like that you can do. So the ones that you can call in, let's say you got a client, let's say one of the people that is watching this today, they are out there saying, oh, you know what? I put in an alarm system the other day. I put in Simply Safe and I have it monitored and I didn't have it before. Mm-hmm. Call up. Tell them, hey, by the way, here's my alarm certificate. I put in a centrally monitored alarm. Okay. You may get a discount. They may apply it. Most likely they'll apply it to the renewal, but you'll get a benefit for that.
Oh.
If you have some of the larger, more elaborate homes, they may have fire sprinklers or they may have fire systems.
Gotcha.
If those are centrally monitored or you have those features in your house, tell your insurance agent, because having like a fire sprinklers inside your home, some of the newer ones have them incorporated. Mm-hmm. You get a discount for that. It's something that the insurance companies go, I know that home won't burn down now if something happens. I don't have to write and price it to replace it all, because if the fire department doesn't get there in time, something's happening to control that fire.
Gotcha. Yeah.
So there's a bunch of little things, and most consumers can call up. It's something good to do every few years to really do a deep dive and really kind of shop and talk to somebody.
Yeah.
If you haven't done it in a while, big one that's always a surprise. This happened. I think you recall when they had the Palisades and Eaton fire a year ago in Southern California.
Yes.
Devastating. It's between 50 and $100 billion of economic loss.
Oh my gosh.
They lost 16,000 structures. Here's the biggest surprise that most insured stumbled on, and they really are stuck. They didn't have the proper insured value. Over time, you get your insurance. We do what's called a replacement cost estimate. When you call me and say, hey, I want insurance, I've got this beautiful $700,000 home I'm insuring, I'm selling, we're going to close on. We look at the pictures with help from you and from the consumer and from what we see. We rebuild that house in this software. All the insurance carriers have this kind of software. And we put, oh, it's got a premium finish. Oh, it's got marble countertops. It's got, premium cabinets. It's got all of these extra features. It calculates based on today's market, what would it cost to rebuild that house? And they look up and they say, you bought it for $700,000. That includes that's marketing, that's your land and everything. But if we had to rebuild it, we'll rebuild that house for $520,000 and you'll get a new house. Well, fast forward, you keep that insurance every year, it renews, you don't have a problem. Now let's pretend you go far out. You're 12 years out. You've had that insurance for 12 years. If you haven't gone in and adjusted that 1% or whatever the insurance carriers tweak that up every year just to accommodate for just, inflation.
Yeah.
We know that building costs have gone up 40%, not 2%.
It doesn't automatically, if you had that coverage, it doesn't automatically adjust for you.
It automatically adjusts by a small inflationary factor, not for what's going on in the construction industry, what's going on with, lumber prices and labor costs. Gotcha. So you very easily could look up and go, I'm $200,000 uninsured.
Wow.
And they'll come in and say, well, let's go back to the example I gave. We'll write a check for $520,000 for that home that we insured. But in today's market, now it's going to cost you $650,000 to rebuild. That $130,000 difference, that's out of your pocket. The insurance company won't cover that.
Wow. So this is all new too, because this was my next question was how often should policies be renewed? Like how reviewed? Every year or not reviewed? Yeah. Sorry, renewed. But how many years do we review our policies every year? What is your sweet spot for?
So that's you didn't realize what an excellent question that is. So some people, and they do this on autos more than they do on homes, but it applies to all the insurance. Some people think every time I'm going to go shop and change because I can save $50. The insurance industry views that as not really great behavior. And over time, you will pay more than if you didn't change every year or every term renewal. Okay. So it's not a good thing to change. It's a good thing. We suggest having you look at it every kind of 3-4 years. It's a reasonable time for you to go in and go, I just want to make sure that I've got the appropriate coverage limits.
Okay.
Doing that every few years, you won't end up with a gap. Now, we have some provisions that we design into our policies. Let's say we had that scenario I gave you. We cover that house for replacement, but we also add on an additional coverage that gives you a percentage above that it just accounts for those inflationary things that nobody thought of. So we tend to do that. It's an additional replacement cost kind of endorsement. We often are able to cover that. So you're okay. It's not like you look up and go, boy, I better do it or I'm going to really be in trouble. If you have a good agent that's looked at doing those things for you, even if the market changes and there was a spike in material costs, we can put on anywhere from 20 to 50% of that additional replacement cost. So let's say it's at $520,000. It's $520,000 plus another 50%. So it's another $260,000 layered on top to account for, well, pricing went up outside of our understanding. So there are mechanisms to do that, but we suggest every few years, just evaluating. Go to a broker, because sometimes we've had people that come in and I don't know, maybe you might have heard some of like your commercial broker, JC, talked about he had been with somebody for many, many, many years.
Yeah.
Always knew that he was covered, but didn't really realize, and just said, well, I met Kevin and I met his team.
Yeah.
Why don't I have him look? Well, we discovered that he was underinsured. We discovered that we could give him better coverage, and actually found a different carrier that was able to give him a much more competitive rate, which he ended up saving money, plus got the right kind of coverage.
Wow.
Those kinds of things are what come out of doing a review. So it's always good to call and say, I'd like to have it looked at. It's been several years, and we'll look at it. We'll look at your house. We'll go, have you done any? Oh yeah, you know what? We redid the bathrooms and the kitchen 2 years ago. Oh, well, that means if you rebuild it, it's going to cost more. Let's factor that in. And you make that adjustment. It doesn't end up costing you much more in the long run.
So
go ahead.
Would it be how you were talking about it being unfavorable to switch from carrier to carrier, correct? If we're doing the review every 3 to 4 years, and say, because everybody's wanting the consumer's business, and just being very hyper aware of not wanting to be one of those people that's not insurable, would it be bad to switch every 4 years? Or
no, it wouldn't. So it's
look at you like
change super frequently. And I use auto because most auto policy terms are 6 months.
Okay.
If you're changing every 6 months, that's not good. Okay. If you look up and it's like I changed, at 2 years, they don't really count that against you. They understand that markets shift, and that makes sense. It's the ones that change that frequently. When they look at a homes they view a little different, because there's a lot of circumstances. It could be that a carrier just decided that they don't want to have. So in the home market, they have what's called capacity. They insure, and I'll use an example that kind of would make sense to people. Let's say the street you live on, an insurance company insures you, but none of the other houses on that street. If something were to happen on your street, a fire were to blow through your street and burn everything down, their exposure is minimized. It's their exposure, and their risk is your one house. Right. Now, imagine that same scenario, but they insure 7 houses on your street, and something happens.
Right.
They look up and they do 2 tests. One is called the capacity. Do we have too much insured risk? Risk is what they, like your house, they call it a risk. Do we have too much insured risk in a particular area that if something were to happen there, it would be a big financial hit to us? We need to adjust for that. So they may non-renew somebody. They may start adjusting their pricing to fit having that much.
Yeah.
And they understand that circumstances like that exist. So somebody changes their home insurance, they don't view it as going, oh, well, boy, they changed. They in the last 5 years, they changed twice or 3 times. They don't view it the same. Gotcha. Because they know that those circumstances exist. Car insurance, a lot different. They look up and they know that, okay, they'll look at the coverage and they'll go, boy, that person keeps changing because it goes up because they filed a claim and then they change to save $50. And that's just not a pattern we like.
Right. Okay, well, we're moving into people who are investors now.
Yeah. Okay.
So this one is going to touch me personally, because I'm buying my first investment property. I'm actually in escrow right now, but I'm also in the due diligence period, and we have found a lot of things going on with the inspection. And so we're trying to figure out, well, do we buy this house or not? And we're talking like major things that would need to be remediated, like mold and water leaks and stuff like that. So what should investors know about insuring rental properties?
Perfect. So there's two things, I'll keep it real high level, two things to look at. One, the type of insurance that you get for an investment property is different than your primary home insurance. Even though they're both homes, they're both houses or whatever, the insurance policy form they're written on is different.
Okay.
So some people think like, well, I bought a home, I bought a second home, now I'm going to rent out my other one. You have to change that insurance because you have the wrong type. This is why it's important. If you ever file a claim and the insurance company comes in and realizes, well, wait a minute, that's an investment property. You're renting it to somebody. You have the wrong policy. We're not paying that claim.
Gotcha.
So you have to have the right kind. For an investor, it tends to be less expensive, that kind of coverage, because you're not insuring a lot of personal and property. You're insuring the physical structure. Somebody else is insuring their own couches and beds and all that stuff.
Gotcha.
So that insurance is different. So that's one. You want to look at the type. And then the second thing that you want to look at is, and you're doing it, is make sure that you look at the conditions of the place.
Okay.
Let's just say you're looking at a place that, boy, it looks like they had some water leaks and things.
Mm-hmm.
As an investor, you want to look up and you want to find out, has that property had a lot of water claims in its history? Because those claims, even though you don't own it at the moment, when you own it, it follows that house. So when you go for insurance, they go, but there were 3 water claims. You go, but I didn't have those water claims. They go, but the house did.
Gotcha.
So they count them against you.
So how would a consumer and investor find that out before they purchase a property, since it doesn't belong to them yet?
So when we go run a property, like let's take your scenario. Let's say you're doing it and you call up our officers, say, great, I'm looking at this investment property. We'll go run what's called a dwelling policy. It's called the DP3. We'll go run that policy for you, and we'll go, and all the carriers run that report. If anything pops up, it comes through on that clue report. It's nothing that an individual, if you don't have an interest in that home, you can't run it. Like if you own your home, you can contact LexisNexis. There is a way that you could go get your report. Mm-hmm. But for somebody buying one, you can't get that report. I can't even go get it independent of writing an insurance policy. Okay. So the best thing to do, put the insurance contingency in your policy, in your offer.
Okay.
And the moment you say, I'm buying this one, contact our office. Let's just keep it simple. We'll go run it. We'll come back to you and say, hey, look, you know what? It came back clean. There was nothing that came up on clue, which means that nothing's happened in the recent history that any insurance company cares about. That's good. And that's how you would find out. Okay.
Gotcha. Okay. That's good to know too, especially representing a bunch of buyers. This is such a good podcast for me to have, so I can just protect my clients a little bit better and protect myself, honestly, because now that I'm starting to dip into investing, there's all these different types of liabilities that I want to make sure that I'm protected, because I have people who are strangers that are going to be living in my properties. You know what I mean? So it's a huge thing and not a normal thing that most people would think of.
Right.
So as far as the seller, insurance policies for sellers, you already said the claims in the history can affect a home, the sale of a home, right? So what should sellers review before listing their properties?
Perfect.
Yeah.
So we'll approach it from two sides. So the seller, we'll use your circumstance, like you're representing, you're listing a property. Uh-huh. You want to go through that and you want to make sure, like, okay, what's the age of the roof? What's the condition of the roof? That's an important one because that's pretty much the first one. All of the things that you and I can do to go look at a house online, an underwriter can do, except they have access to some pretty savvy satellite imagery and stuff. So they can see granular detail that even you and I can't. So you want to look up and you want to approach listing, either person selling their house or if it's a listing broker. Go approach that as if, what am I looking at from an insurability standpoint? Because you don't necessarily care as a person selling it, but if the person buying it can't get insurance, it matters to you. Right. So you're going to look at the systems. I mentioned those systems. It's roof, it's plumbing, electrical, HVAC.
Yes.
Look at those things. If they're in reasonable condition or you don't have something that's really out of compliance, you're good. The easiest way, people go, well, how am I going to know if my electric panel or plumbing's good? Well, if you ever did a renovation or anything, an electrician comes, they have to sign off that house is to code. Right. They're not, if they see that you've got high risk or out of code breakers, they're going to say something about it and switch it. Not a big fix, but usually that's why when we talk about, did you do any renovations? We say, 5 years ago, they renovated the bathrooms and kitchens. We check that as doing a plumbing and electrical upgrade because we know that a licensed professional looked at it. We know that they would have identified a problem and corrected it. So that's the way the insurance companies look. So just view it that way. You want to, obviously you do the things that you do for marketing, make it look, you clean it up. If you got a lot of debris in your yard and stuff, clean it all out, make it presentable. And those are the important things. So you look at the major systems, and as a homeowner, have them go to their agent and say, I'm considering listing my house. I'd like to know, is there anything on the clue report? I didn't file any claim, but I've only owned the place for 5 years. I don't know really what happened before that. So go do that. You're pretty solid at that point.
Okay.
Now, you switching hats to the buyer, you're looking at the same stuff. So if the listing agent has done a good job at addressing all those things up front, when a buyer comes along, they're less likely to find something that's ineligible, and it makes that transaction that much easier to close.
That is so, gosh, I'm taking notes as we're going on.
Great.
Just so you know, all the viewers are probably like, what's she doing? I'm taking notes for myself. Notes are here to help me with my clients in the future and myself. So what should Las Vegas homeowners be aware of today? I know we talked about wildfire risk, earthquake. Is that important in Nevada?
Yeah. So actually, I had pulled up something earlier when we talked. Older homes as well, since we have a lot of old homes now.
Yep.
So here's something important to know. All homeowner policies, they don't cover two major things. One of them we're very accustomed to and it makes sense. The other one people go, oh, I didn't know. That's flood and earthquake. So a typical homeowner's policy in general does not offer any coverage related to those two perils. That's what the insurance industry calls those kinds of events. So just giving you an idea, people go, well, but we're in Nevada. What do I have to worry about? Let's see. In the past day, let me see, earthquakes in Nevada. This is the surprising kinds of stats.
And today's, just so everybody knows, so viewers know, today is July 28th, 2026. Yep. So current time, we're talking about stats and earthquakes.
Okay, so in the past, there were 4 earthquakes in the past 24 hours. And in the last week, 57 earthquakes in Nevada. In the last month, 168. They happen. They're not major ones like we hear about in San Francisco and some of, in the Philippines and places like that, but they happen. In Northern Nevada, Silver City, I think it was, they had a pretty substantial one. I think it was a 5.8 or 6.0, something like that, that was kind of 2 miles from downtown Silver City. It got everybody's attention. Homeowners insurance does not cover damage from an earthquake. So here's how insurance looks at damage. If you call up and say, hey, I've got damage to my house, the insurance claims process says, what was the cause of that damage? So they'll backtrace it. They're very good at it. Claims adjusters are very good at evaluating damage and seeing what happened. If the result of that damage was an earthquake, they'll go back to your policy and they'll say, oh, you don't have earthquake coverage. Therefore, we're not covering that damage. Earthquake is a big category that has its own insurance, just like flood. People are familiar like, oh, well, I don't live in a floodplain. Well, everywhere technically floods. There isn't anywhere in the planet that doesn't have a flood risk, because flood is categorized as earth movement like mud flow. It's categorized as heavy rains cause water to, and there's a formula for that. Well, they don't cover that. Everybody's accustomed to, oh, I buy a policy if I want flood coverage, not a super high risk in most places, so I don't have to, but it's something I buy. Earthquake works the same, not covered, but you can buy it. And if you're in a high risk zone, it tends to be a little more expensive. If you're in a low risk zone, where in Nevada, most places here are not super high risky. We don't get big, massive earthquakes all the time,
right?
But we get small ones frequently. So it's priced accordingly. It's not too terribly expensive, but you do need to get it. But you hit on it. Most people think, oh, Nevada, I don't need to worry about it. Well, just go Google it. Go Google how many earthquakes happened in Las Vegas, Nevada in the last year. And you'd be surprised to go, oh, wow, they happen for more frequent than I thought.
Right. And I believe there are a few faults that are running through Nevada that most people don't know about. I know a lot of people think about the San Andreas fault, and there's movies around it and stuff like that. But yeah, it's a good question. And how, as far as people you've insured in the past, do most people tend to get flood and insurance?
So yeah, that's a good question. So there's two things that we ask that are, let me back up. If you have a mortgage, one of the things that the insurance company assesses and the mortgage company is looking at is if you're in a flood zone.
Okay.
Flood zone, I'll keep it simple. There's a very low risk, which is called flood zone X. And to get a loan, they don't require you to carry flood insurance. Okay. And then there's a whole bunch of different other letter designations, A, E, and flood zone A, and a whole bunch. If you're somewhere that is near somewhere that has water flow, the FEMA does these maps and they reassess and see where are the likely areas that water could penetrate. And you can look up an address and it pops up and it shows you, oh, that house is sitting somewhere that potentially could have water overflow from a neighboring creek, or it could be from heavy rains. There's a wash that runs behind the house that could overflow. Yeah. They look at that stuff. And if it's in one of those zones, they'll require you to get flood coverage before they'll allow you to close on that loan. So you have that catch that on the flood side says, well, if you're in a risk area, you got to get it. You can get insurance regardless. Even if you're in flood zone X, it tends to be very inexpensive. But most people don't know that, like, well, I'm not in a flood zone. I'm not worried about the creek overflowing because I don't have a creek.
Right.
Yeah, but if you have a heavy rain, how many times in Vegas have we looked up and the streets are flooded?
Oh my gosh.
Um, it happens.
It happens.
Well,
Yeah.
that's flooding.
Right.
That's not covered under your homeowners. That would be considered a flood event. And that kind of coverage is what you would need. And we ask if people want it. Most people say, oh, I don't think so. And I don't really think it's a risk. I don't need it. That's a preference. Same thing for earthquake. Earthquake is an optional coverage. It's not a mandatory coverage, but it's a good thing to have. If you're somewhere that you worry about it, I could get an earthquake and I could end up with a crack in my foundation. Well, that's possible.
Yeah.
Is it likely it's going to happen? Nah, probably not. Is it something I should have? Yeah, I should. If you have that coverage, well, then you file that claim and now that's taken care of. If not, you're paying out of pocket.
So just a general, how much additional cost would a flood and earthquake insurance be on top of your regular policy?
If it's not a high risk area, you're talking for the year, a couple $100. I mean, it really just depends on the address, and it's all environmental. They employ all kinds of environmental elevation and factors when they're pricing it. But if you're somewhere, let's say you want to live next to kind of hard in Clark County because we don't have a lot of it, but in other parts of Nevada you have it. I live near a river. Okay. They'll look up and that could end up like, oh boy, that policy, that they live so close, and it runs the risk of overflowing so often that policy might be $1,000 or $2,000. Don't know. It really depends on the circumstance, but it's usually something that's measured in hundreds, not thousands.
Gotcha.
And it's very location specific based on the environmental conditions. All the carriers subscribe to a bunch of the databases that are out there on, fault lines and fault frequency and stuff like that. So that's how they base their underwriting.
Gotcha. Okay. And just so our buyers know or homeowners know, you're not paying insurance separately from usually bundled within your mortgage. So I know a lot of people will think about home mortgage or home insurance, and maybe people who don't own properties are probably thinking like, okay, this is an extra expense? No, everybody, it's all bundled together with your mortgage, just so everybody knows.
That's the other thing. I'm glad you brought that up. Like when somebody is existing insurance and it's part of their mortgage and all, and they shop it, sometimes they just forget about it and keep paying. Well, I got another 5% increase. I keep paying. They don't really see it because it comes through on their mortgage and they adjust their monthly payment.
Right.
You can go shop it. Let's say you go shop it and find better coverage, and it happens to be that you get a better rate. They don't pay for that. What they do is we'll write it, and then we go notify the mortgage company and we send them the information on the client's behalf, and they go in and they just adjust it. They pay for the new insurance, they cancel the old, they get the refund from the old insurance, and the new insurance is now less. And it's done behind the scenes. It's nothing that somebody goes, oh, I've got to end up paying out of pocket. But because it's wrapped into their mortgage payment, it's kind of out of sight, out of mind.
Right.
And most people don't think there's nothing wrong with you shopping it, because there's a big piece of a homeowner's insurance policy that goes outside of the house. That's the liability side.
Yeah.
And most people don't know that your liability coverage follows you anywhere in the world. Like, let's say you have your homeowner's insurance and you've got personal liability coverage, and you're out at a restaurant. You set your purse down next to your chair, didn't really think about it. Somebody walks by, trips over your bag. They fall, they break their arm, and now they're suing you for this pain and suffering, and they got a good attorney. And now all of a sudden you caused them this big problem. Your homeowner's policy is what steps in to protect you.
Oh.
You had a personal liability claim against you, and they step in to say, I'm protecting you against that claim.
I don't think that most consumers would know that they have
Yep.
personal liability through their home insurance. This is a typical.
It's a standard coverage on, so there's a handful of standard coverages. Real quick so people get it. Your main house, that's called your dwelling coverage. That's your house. That's, everything that's attached to the house. They have something called other structures, which is part of every policy, and it's a different limit level. And that's, let's say you have a detached garage, or you have a workshop in the backyard. That coverage covers for that structure. If it's not physically attached to the main house, it's covered under other. Then you've got what's called loss of use. That's, let's just say you have a kitchen fire and your homeowners, you have the coverage and it's covered, but boy, while they're doing the repairs, I can't live in the house. What happens? Well, there's actually a provision in your homeowners policy that will pay to get you put up in a hotel or a temporary apartment or something for 2 months while they make the repairs to make it habitable again.
Yeah.
And then they've got this other grouping that's called liability coverage. And that's typically personal liability. That's kind of the scenario I gave you. And that usually is like measured like $300,000 of coverage or $100,000 of coverage. We tend to push people to $300,000 to $500,000 because incrementally it's cost of a cup of coffee for that difference. So why don't you just get the better coverage?
Right.
And then they have something every policy has that's called med pay. And most people don't know about that. It's on your car policy. It's on your home policy. That's for minor medical things that happen to others, either in your home or in your car. Let's say you have a party, somebody cuts themselves, they drop a glass and cut themselves, and they got to go to the urgent care to get stitched up, and they incur $800 urgent care visit. Well, that provision helps pay for that. It keeps it out of being a big medical claim. It doesn't have to be covered, and it's built into every policy. And it's usually about $5,000 of coverage that's included. You can change that in some policies. Some carriers allow you to up that to even more, but typically it's a few $1,000s. It's usually included, and most people don't know.
Yeah, and that's true. Most people don't know what I didn't know.
Yeah.
And that's true. There is a lot of coverage that insurance is, I feel like, to the typical consumer, if you're not working in it, it's kind of like a big mystery.
Yeah.
What is
it? And that's why you need that's why most people don't think. I like, when I give talks, I talk about this. I say, well, when you have a legal problem, you call an attorney. When you have a tax problem, you call a CPA. When you want to get that best real estate, you call a real estate professional. Most people don't think that, oh, I've got insurance thing. They're kind of duped by the insurance marketing that I can just go online and click and get insurance.
Right.
Well, it's complicated, and you can get insurance, but it might not be the right insurance, and you're paying for something that doesn't protect you. We're a licensed industry. I'm a licensed professional. I have continuing education every year I've got to do to maintain my license. Treat it like, calling an attorney or CPA. If I've got an insurance problem, why am I trying to navigate it myself? Why don't I just get a professional? And here's the beauty of it. You don't pay for our service. You don't have to call and pay me and say, well, what's my hourly rate with you? No, I'm there to help guide you. And if I'm good enough and you trust me enough for me to buy the policy for you, we're compensated by the insurance carrier that has a provision of that premium that's a commission to us. If I don't do a good job protecting you, then I don't get paid. So my job is to make sure I get you the right coverage and make sure you're protected. And that way, then I'm compensated.
Oh, we're living parallel lives, right?
Yes, exactly. If they don't buy a house, then you don't get paid.
Right. If I don't take care of them all the way through the end, then nobody's getting paid.
Right.
So our very last question, what would you give, what advice would you give homeowners today?
Do yourself a favor and contact a broker. Our insurance commissioner in the state of Nevada, both the last one and the current one, anytime he's out in the public, he's recommending call a broker, because we all are licensed the same, except a broker has access to more options and can better place you. So if I were to give advice, there's nothing wrong with a captive. There's nothing wrong with a State Farm or a captive agency. They're great companies. The professionals are licensed the same as me. They don't have the same options. So give yourself a better chance. You want to, when you're going out, when you select a realtor, you want to find one that, wow, they're really knowledgeable of Clark County, and they're knowledgeable about so many different things. I didn't know that community had these benefits, but they did, because you take the time to learn and keep yourself informed. We do the same thing. We spend a lot of time educating ourselves. We're unique as a broker to have so many different companies we work with. So we see things that most people don't, and we're able to pass that on to you. So if you're going to do yourself a favor, talk to a broker and just ask. There's nothing wrong with asking and shopping your insurance. That's an important thing to do, and it's a good starting point. And restart that clock so that you can feel confident that you're covered if something happens.
Okay, so now I'm down to my rapid fire questions.
Okay.
So, cheapest policy or best coverage?
Best coverage. Best coverage always, and first foremost. Paying $10 for something might not be the best coverage, and you want to be protected. You're buying insurance for that event that you need it, not to say you have it and check the box. You want best coverage. Okay.
True or false? Flood insurance is included in homeowners insurance.
Your listeners can answer that one too. No, it is not.
One question buyers should ask their insurance agent before closing.
Is it a bindable quote?
Is it a bindable quote? Yes, and we spoke about bindable. The two things that include that are bindable is the address and the actual insured person.
Right.
Yep. Okay. All right. And so, very last question, reminder of who you are and how people can connect with you.
Sure. So my name is Kevin Musico. My last name is Musico. I'm the co-owner with my wife, Lori. We own Goosehead Insurance, the Musico Agency, and we are on all social media platforms. You can look us up on the web. Make sure you do Goosehead, the Musico Agency, because there are other Goosehead brands out there. And our local number for our Clark County and Southern Nevada clients is 702-267-6207. And we are licensed in multiple states, so we can help people all over.
Cool. Well, thank you, Kevin. I really appreciate you coming and doing my podcast today. It's really informative, and honestly, it was really educational for me as well. So I really appreciate you being here. I know it took us a little bit of time to get together, but we did it. So
yeah, I'm glad you did. I really enjoyed it, and for you, all your colleagues, and even your clients, it's better to reach out and ask the questions, and that's what I'm here for. I'm happy to do it. You and your colleagues see me all the time at your Keller Williams offices, so be sure to pull me aside. I'm happy to help you with anything.
All right. Well, thank you, Kevin. I appreciate you. You have a great day, and everybody, thank you for stopping by and watching Lux Living with Carey in Las Vegas. So we'll see you again on the next podcast. You guys take care.